This Chapter 3 describes the methodology behind S&P's determination of the industry risk component of its BICRA. The table appearing now lists the factors and subfactors that determine the industry risk score under BICRA. The three factors S&P considers are institutional framework, competitive dynamics, and system-wide funding. Under institutional framework, the three subfactors listed are banking regulation and supervision, regulatory track record, and governance and transparency. Under competitive dynamics, three factors again are listed. Risk appetite, which comes with an additional adjustment for non-loan assets, industry stability, and market distortions. And under system-wide funding, the four subfactors listed are core customer deposits, external funding, domestic debt capital markets, and government role. As before, each factor listed above is scored on a numerical scale that ranges from 1 for very low risk to 6 for extremely high risk, based on analysis of the characteristics associated with each factor and subfactor. The overall assessment of industry risk is again determined by the number of points assigned to each risk score, as shown on the table reappearing now, where you will recall the first three categories are assigned points equal to their risk score, while the remaining three categories are penalized in a gradually increasing manner. The point total for the industry risk score is reconverted as before into a unique score on a 10-point scale, with the table reappearing now, showing how, with 1 again representing the lowest risk and 10 the highest risk, but where we remind you the table does not follow a linear approach. Our next step is to comment in greater detail on each of the subfactors we listed above. The initial assessment of a banking sector's institutional framework is based on the evaluation of the first two subfactors, banking regulation and supervision, and the regulatory track record. These two subfactors together are used to derive the institutional framework risk score as described in the table appearing now, to assess the scope and intent of the regulatory framework. Banking regulation and supervision is quote-unquote strong if banking regulations are more conservative than international standards, regulators monitor banks closely and frequently in an effective and hands-on manner, regulatory coverage and reach is extensive so that virtually all types of financial risks are captured, and either there is only one central regulator for financial institutions, or there is close cooperation between the different supervisory authorities. The regulatory track record is deemed strong if the authorities have taken preventive measures and thereby reduced vulnerability to crises over past economic downturns. Under the criteria, Canada, for example, would have qualified as strong based on its track record leading up to and after the 2007-2008 financial downturn. Banking regulation supervision is deemed of intermediate quality if banking regulations are typically in compliance with international standards, regulators usually monitor banks closely and frequently in a moderately effective and hands-on manner, but with gaps occurring, and regulatory coverage and reach is fairly broad so that many types of financial risks are captured, although some lapses do exist. The regulatory track record is deemed intermediate if the authorities have had to support banks with capital injections to avoid bank failures in past economic downturns. In some instances, regulators may have identified problems at an early stage and acted quickly to remedy them. Finally, bank supervision is weak if bank regulators are more lax or lenient than international standards. Supervision is less effective and less hands-on, and the monitoring of banks is on an ad hoc basis with significant gaps or delays. Regulatory coverage and reach have gaps so that several types of financial risks are not captured, and regulators may be subject to political influence that weakens regulation. Similarly, the regulatory track record is weak if the authorities have had to support banks with significant capital injections to avoid bank failures in past economic downturns. If regulators may have been more reactive than proactive in past crises, and may have had authority to remedy problems early, but may not always have exercised the authority. Or, alternatively, if supervisors lacked capacity and authority to address problems early in certain important areas. Under the criteria, Ireland, for example, would have qualified as weak based on its track record leading up to and after the 2007-2008 financial downturn. The two sub-factors we have discussed already, banking regulation and supervision and regulatory track record, are assessed on a best fit basis according to the descriptions in the three preceding tables. These assessments are then combined as shown in the table appearing now. An initial risk score of 1 is awarded if both sub-factors are assessed to be strong. Then, as you can see, the risk factor increases towards 5 as the various combinations of assessments diminish in quality, with a 5 being awarded if both subfactors are assessed to be weak. The third subfactor, the adjustment for governance and transparency, now comes into the picture and generates a one-notch negative adjustment to the initial risk score under certain circumstances. The table appearing now shows how this subfactor is classified into one of two categories: at least adequate or weak, with the former leaving the initial risk score unchanged and the latter giving rise to a one-notch adverse adjustment to the initial risk score. The first category includes systems that boast adequate or better governance and transparency, and at least a moderate degree of disclosure of ownership and banks' accounts, as measured by the frequency and timeliness of reporting, quality of financial reports, and degree of standardization. While the second category is characterized by weak governance and transparency, in which many aspects of ownership, management, and governance lead to risks, with evidence of uneconomic directed lending and/or lending to parties related to owners, and/or by an inadequate degree of disclosure of banks' accounts as measured by the frequency and timeliness of reporting, the quality of financial reports, and the degree of standardization. Illustratively, S&P classifies the United States in the intermediate risk category with regard to this first industry risk factor, institutional framework. Acknowledging that the U.S. financial system is innovative and dynamic, reflecting the strength of its varied participants, S&P worries about the, quote, considerable regulatory challenge, unquote, of keeping the system under control while allowing prudent risk-taking and market-based solutions. According to the rating agency, the recent crisis revealed substantial gaps in supervisory oversight and complex financial instruments, and the interconnections between banks and non-banks, and thus over the funding and liquidity risk of the banking system. Indeed, S&P states that the U.S. regulatory track record is one of the key constraints on the institutional framework score. The failure to prevent the most recent banking crisis is noted carefully, but S&P recognizes that substantial improvements are expected to follow the enactment of the Dodd-Frank Act and the Volcker Rule, especially with regard to the increase in capital ratios for so-called systemically important financial institutions, the broadened oversight of derivatives, the proposed margin requirements for registered swap dealers and other non-bank swap entities, and the more stringent liquidity requirements that will apply in the future. The transparency of the U.S. banking system is a relative strength, with extensive quarterly reporting covering a broad range of financial indicators, off-balance sheet activities, risk management, and legal risk. In addition to U.S. accounting standards for valuing assets that banks carry on and off balance sheet, and for the early recognition of problem loans and subsequent write-offs. The second factor under industry risk is competitive dynamics, whose three subfactors are risk appetite, industry stability, and market distortions. The initial risk appetite score is slotted into one of four categories, from very low to restrained to moderate and finally to aggressive, which convert into an initial score from 1 to 4, as you can see. These classifications are based on the following criteria: the banking system's profitability and how it compares to that of other sectors in the economy, with higher relative profitability typically meaning higher risk tolerance. The balance between capital strength and profitability on the part of the largest banks. The presence or absence of innovative, complex, and risky products in the market, including the use of securitization techniques to shift risks off the balance sheet. The extent of high-risk lending. The bonus culture in the sector, and whether compensation practices reward or discourage risk-taking. And the extent of growth in total assets in the sector. The next table, appearing now, illustrates how S&P ascertains the stability of the banking system with three possible classifications, ranging from at least moderately stable to moderately unstable, and finally to unstable. The initial competitive dynamic score remains unchanged if the industry is deemed at least moderately stable. It suffers a one-notch adverse adjustment for moderately unstable systems and a two-notch adverse adjustment for unstable systems. The classification, as you can see, is a function of the stability of the competitive environment and the degree of overcapacity, as evidenced by the earnings level on core banking products and vulnerability to new entrants or to a material change in the competitive environment. The last subfactor under competitive dynamics is market distortions, whose presence, as you can see in this table, gives rise to a one-notch adverse adjustment in the initial competitive dynamic score. Characteristics of this subfactor are the presence of significant government-owned and/or not-for-profit banks that do not operate on full commercial terms, the frequent use of administrative controls over deposit and lending rates and/or material government-directed lending, and the nature of competition from non-bank competitors such as investment funds, finance companies, and securities markets. Illustratively and interestingly, S&P classifies the United States in the high-risk category with regard to the second risk factor, competitive dynamics. The open and dynamic nature of the U.S. banking system promotes efficiency and innovation in the world's deepest capital market, but may also lead to aggressive commercial products and practices that amplify the highs and lows of credit cycles. S&P does not discard the possibility that a fresh batch of high-risk, high-margin products could be created to replace the old ones being phased out because of post-crisis restrictions. This is partly because bank profitability has been trailing the performance of non-financial companies since 2008, with an average ROE around 8% versus 26% for S&P non-financial companies in the S&P 500. The system's stability does not detract from the competitive dynamic score. The U.S. banking system is more concentrated than the total number of institutions suggests, with consolidation having intensified since the global financial crisis. The top 3 banks now control 38% of total commercial bank assets, and the top 10 banks control 59%, indicating that smaller banks have a limited impact on the sector's performance and overall risk profile. Market distortions are significant, however, with non-banks, defined as money market funds, ABS issuers, finance companies, REITs, brokers and dealers, and funding corporations, remaining significant players in the financial industry. Additionally, the 2008 conservatorship of GSEs Fannie Mae and Freddie Mac increased even further the subsidy enjoyed by those two entities, even though their regulator is proposing to raise the fees for their guarantees to what they would be in theory in a purely private market. In short, S&P views the sizable presence of non-banks and the continued prominence of the GSEs in the U.S. mortgage market as market distortions that contribute to its high risk assessment in this category. The last industry risk factor is system-wide funding, which assesses the relative stability of a banking sector's funding sources and its access to alternative funding sources, and is determined via 5 subfactors we mentioned earlier. Core customer deposits compared to loans, external funding, non-loan assets if applicable, domestic debt capital markets, and government role. The table appearing now establishes an initial system-wide funding score as a function of the first 2 subfactors, namely net external debt as a percentage of total domestic loans and domestic core customer deposits as a percentage of total domestic loans. As usual, these scores range from 1 in cases in which domestic core deposits exceed domestic loans and net external debt is negative, to 6 in instances in which both of these factors are at or around the 40 to 50% zone. The reasoning here is that core deposits, which S&P defines to include 100% of retail deposits and 50% of corporate deposits, are a bank's most stable funding source. For this factor, however, a large number of additional potential score adjustments are listed next in the S&P criteria, to which we will turn in just a moment. If, for example, the banking system has suffered one or more instances of lack of general depositor confidence, i.e. a run on deposits during the past 2 decades, the initial system-wide funding score is capped at no better than 3, whereby capped we mean that the score as a number can be no lower than 3, since lower scores are associated with stronger systems. We saw in the table above that external funding is the second determinant of the initial system-wide funding score, but this comes with additional qualifiers. The ratio in the table is defined specifically as the banking sector's 2-year average annual net external debt, including non-resident deposits, as a percentage of total domestic loans. The criteria view cross-border funding as a vulnerable source of banks' funding during economic, financial, and liquidity distress, benefiting the system during benign periods when liquidity is ample and investor appetite high, but likely to be the first to evaporate in difficult times. The adjustments required by S&P to the initial score are the following. In the case of banking sectors that are largely foreign-owned and thus receive a large part of their funding from externally based parent banks, This high dependence on external funding would be mitigated if it could reasonably be expected that funding from the foreign parents will remain stable over time. In such cases, the initial funding score benefits from a one-notch upward adjustment. Conversely, in the case of banking sectors that have a very high degree of customer deposit funding, because there are few alternative investments for depositors, and for whom access to external debt capital markets is very limited, S&P caps the overall funding score at no better than intermediate risk at best. S&P also views with some suspicion wholesale funding associated with a large securities portfolio, typically government, corporate, or structured securities, given how confidence sensitive it is. S&P therefore imposes a one-notch adverse adjustment on the initial funding risk score of banking systems whose system-wide domestic loans account for less than 40% of total system-wide domestic banking assets. The fourth subfactor under system-wide funding relates to the domestic debt capital markets. S&P regards domestic debt capital markets funding to be more stable than cross-border funding, but less stable than core customer deposits. The criteria assess the breadth and depth of the domestic debt capital markets by examining the issuance of short and long-term securities by both financial institutions and corporations, but not the sovereign, as a percentage of GDP. The table appearing now classifies the assessment of domestic capital markets into three categories: from broad and deep, which improves the initial funding risk score by one notch, to moderately broad and deep, which leaves the initial funding risk score unchanged, to narrow and shallow, which gives rise to a one-notch adverse adjustment. The classification is driven by the number of desirable characteristics shown by the domestic debt capital markets, as you see at the bottom of the table starting now. The three characteristics in question are: private sector debt issued in the domestic capital market generally exceeds 25% of GDP. Second, there is an active capital market for the private sector for issuance of investment-grade debt for banking sectors with investment-grade banks, and/or non-investment-grade debt for banking sectors with non-investment-grade banks. And third, there is an active capital market for debt securities with either long-term maturities, i.e. greater than 7 years, or with medium-term maturities, i.e. 3 to 5 years. The last subfactor, finally, assesses the extent of system-wide funding support from a government for a banking system by looking at the central bank's lending facilities for the banking system, the type of collateral the central bank accepts, and any government funding guarantees. The table appearing now shows how the government's role in system-wide funding is classified into one of three categories, ranging from strong, which gives rise to a one-notch improvement in the initial funding score, to adequate, which leaves the funding score unchanged, to weak, which gives rise to a one-notch adverse adjustment. The criteria used to determine this classification include the following: how effective the government's track record has been in providing guarantees and liquidity during periods of market turmoil, how strong the central bank's lending facilities are in terms of capacity to service the industry's funding needs, and how responsive the government has been and how flexible to changing industry needs. Illustratively, S&P classifies the United States in the very low risk category with regard to this third risk factor, system-wide funding. Since 2008, deposits have grown disproportionately, while the economy has moderately deleveraged and loans have shrunk, resulting in a ratio of core customer deposits to loans of 106% as of September 2011, up from 84% in 2008. Furthermore, core customer deposits now account for 64% of total system-wide liabilities versus 52% in 2007. Net external funding of the banking sector is only about 6% of system-wide loans and is almost entirely in US dollars, which mitigates external funding risk. The dollar's preeminence as a global reserve currency gives the US more room to carry external debt, and this unique status is expected to continue for the foreseeable future. US domestic capital markets are the deepest in the world and among the most liquid. Financial institutions' debt securities, including commercial paper, cover 45% of banks' liabilities as of the end of 2011, although this proportion has declined in recent years because of banks' lower appetite for wholesale funding. The government's role in system-wide funding is considered strong, given its record of providing guarantees and liquidity during the last financial crisis. And the Federal Reserve continues to have the authority to use emergency lending facilities at times of system-wide stress. Combining the U.S. intermediate risk classification for institutional framework with the high risk classification for competitive dynamics and the very low risk classification for system-wide funding, in accordance with the 10-point approach outlined in Chapter 2, leads to a score of 4 overall for industry risk. There is one final caveat which brings us to the end of this chapter and of the entire discussion of the industry score under BICRA. In the case of a sovereign government under credit stress, where this has impacted and possibly closed market access for the banking system as well, the criteria assign a final funding risk score of either 5, i.e. very high risk, or 6, extremely high risk, depending on the severity of the impact on the banking sector. From all of the above, we derive the banking system's economic risk score as per Chapter 2 and its industry score as per this chapter, reminding you that each of these two scores will fall between 1 and 10. All that remains is to combine these two scores to determine the overall BICRA group in which the country's banking system will be classified. The table appearing now shows how these two scores are combined together and is self-explanatory. Thus, the combination of an economic risk score of 7 and an industry risk score of 2 produces a 5 overall, while the combination of an economic risk score of 3 and an industry risk score of 8 produces a 6 overall. And as anticipated, the lowest and best score is a 1, and the highest and worst score is a 10. In the specific case of the US, the combination of an economic risk score of 3 and an industry risk score of 4 produces a 3 overall. In subsequent chapters, we will see how S&P proceeds to use the BICRA score as the launching pad for the rest of its bank rating methodology. But for now, we come to the end of this chapter 3 and of part 1 of this module.